This is the What's Next podcast, and you're entitled to listen to this as long as you don't work at the IRD, because in this podcast, we're going to break down exactly how to minimize your tax and make sure that you pay as little tax as possible. Phil, I don't know anything about this, but I hear you do. Take us through it.
Thanks, mate, and I appreciate the great introduction. And yes, I just need to re-emphasise that if you are with the IRD, please exit now for your own benefit. For those of you that are continuing, we've got 5 top tips on how to minimise your tax or maximise your deductions. I don't know if it's 5, I just made it up. Just a bit of clickbait.
I like it. So here's the 5 top ways to decrease your tax.
Yeah.
Kick us off with number 1, mate.
Number 1 would be cashies.
Cash jobs?
Yep, 100%. Look, I think it's really important to address the elephant in the room that the IRD are continually going out there and trying to chase. I don't know what an elephant likes to eat, but maybe they should try and dangle some of that food if they want to be able to catch it. But it's a fact of the way the economy works that people are going to be prepared to pay cash to someone that doesn't want to declare it. We can't endorse that behaviour, but if you are getting paid in cash, you're not going to be, if you're GST registered, paying the GST on that income, and you're not going to be paying the income tax on that income. So if you're at, say, a 30 or 33% tax rate plus the GST, there's 40-odd% of tax there that's not going in the tax system to invest in our police service, our healthcare,
Teachers.
our roads, teachers,
Government salaries.
Yeah, and I was going to take a dig on the, from our budget podcast, and we've got to keep thinking of the boomers and the older generation.
The superannuitants on welfare.
Yeah, our largest beneficiary group. Yeah, they're relying on your taxes.
$100 billion over the next 4 years, I believe, Phil.
Yeah, that is the case. So, cashies might make it difficult for them to be paid, but we cannot endorse cashies. Do not do cashies. If your accountant asks if you've ever been paid for anything cash, complete that questionnaire and say, yes, I received whatever it was. If you receive cash, toddle down to the bank. Go and get a cup of coffee on the way.
Bank it.
Bank that cash.
Yeah. Especially if you're creating invoices in Xero and then you're taking cash payment, you're going to need to match those off as being paid. So you're going to need to bank that cash to ensure that you
reconcile it. Yes. Yeah. Otherwise, your accountant is going to be getting their knickers in a twist that there's going to be these invoices outstanding that they haven't been paid. And they'll be like, well, do we write these off as bad debts? Oh, no. We got paid for those with cash and we banked that cash.
It's funny you say the elephant in the room, mate. I thought you were going to say the elephant on the construction side. But anyway, they'll take us into tip number 2 to minimize your tax. Now, say you are in that construction industry, I believe that what is something that could happen that would allow you to decrease your tax would be running through some of those materials for your own stuff through your business, which would highly suggest you do not do that. You have to be aware that you're claiming a deduction on personal expenses through your business, and that's actually tax avoidance in some regards.
I was just about to say, mate, maybe we could rename this pod to the top 5 tips for tax avoidance that are going to land you in jail.
Yeah.
The amount of people that think, we'll just run, and yes, there's some industries, tradies, that are more prevalent at doing it than others. And it shows up in your margin. And what people don't appreciate is that when your accountant prepares your tax return, there's a form that gets filed with the tax return called an IR10. And that's got some key numbers that get put in it. One of them being your sales, the other one being your purchases that works out automatically what your gross profit is. Yeah. And it's pretty easy for businesses to go, you know what? I might put the swimming pool through to purchases.
Swimming pool.
Yeah.
Yeah, okay. For the build that we're doing over in whatever Ave.
For the build, yeah. And I've just, I've got my work car, but I've also got my private car that's running on these fancy European tyres. I'll just run them through the motor vehicle expenses rather than paying for those personally. Well, IRD have got this form that gets filed called the IR10 that goes into their fancy-as computer system that will go and do some analysis over it and can easily identify the anomalies, the ones that stick out like a sore thumb. And if everyone else in your industry is doing a gross profit of that magic 30% and yours is coming in at a 9% year after year after year, you bet your bottom dollar that you might be getting a please explain letter from IRD to go, Hey, what are you guys actually running through this joint?
Yeah, what's going on? Yeah, of course, construction, we're picking on that industry, but it is one that the IRD keep an eye on because it does seem to be an industry where there are a number of ways that they get creative to try and keep their tax down, right? So they're not only doing things like that to try and keep their profit down, and then they think, well, maybe I should be hiring my wife or my husband in this role as well, and they start to pay them wages, but they're not actually doing any work for the business. Now, that could be a little bit naughty as well. But to be fair to construction, there actually is a lot of people, as you know, especially lads in construction, their wives at home that end up, or partners end up tidying up the admin in the evenings, and they get pissed off with their husband or partner in the evening being like, for God's sake, I've got to tidy all this up. I would suggest if they are doing that, then ensure that they're getting paid for that.
Yes.
You know, like remunerate them so that they're not just like, oh, I'm doing this for nothing. And it's really, really common for that to actually be happening. So there is some legitimacy to that as well.
Look, I think at this point it would probably be appropriate to go to interject with the top 5 tax avoidance techniques that are going to land you in jail and readdress the mindset challenge that people face and go, paying tax is actually a good thing. If you're paying tax, it means you're profitable. And that's ultimately what we're trying to achieve in business is making a profit. Otherwise, why do it? You know, we're risking it for nothing. And the mindset that comes with tax is, and then having to pay IRD is probably a cash flow issue. And that's where people are going, oh, I don't like paying tax. It's a cash flow issue. Not the fact that you've made the profit. That's great. It's just you've gone off and spent the profit without actually thinking about the tax.
Yeah.
So maybe it's time you start and do some education yourself on understanding how all of that stuff works so that your relationship with tax and cash flow improves, because it isn't going away. Tax has been around for a blooming long time.
Yeah, I do think we're in a bit of a wave of the anti-tax at the moment because we've had high inflation, so it's felt hard to have money left over. We've seen the tax take skyrocket and go up as well, from the total tax take and individual tax take. And then you've got the narrative of, I'll be happy paying tax if it was used well, it's wasteful. And I think even some of the political parties have used that term a lot, like wasteful, this is wasteful spending. We hear that all the time. And so then when you see that money going out or having to pay lump sums over, you're kind of going, oh my God, like that. And so I think
leave it to me to invest it and I'll do a better job.
Yeah. And that's where I think some business owners are now, you know, being a bit more risque and going, you know what, like, we're going to do this. And some of the things that we've read about in Facebook groups where people are, you know, putting invoices for their personal stuff, you know, under their business, and buying groceries under the business, and that's completely fine. And people are like, well, no, you can't do that. And like, oh, well, stuff it. And you kind of think you've just outed yourself on a public forum that you do that. And if the IRD are watching those, then it wouldn't be hard for them to do a random. And a thing I cracked up about the other day, mate, is I actually posted on Keep the Change about, does anybody rent out their home and then go and rent somewhere else? And so many people were actually like, yes, we do this, we do this.
Yep.
And I actually left a comment, I was like, oh, hey, before you gun-ho go in here, you better make sure you're returning your income, because that's a form of income, because you're about to leave a comment which is actually going to tag you as somebody that's very easy to check. Do they have rental income or expenses in their tax return? No. That's interesting. And knock, 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 hello. And I think there are so many people that now have a side hustle or now rent their property out and don't realise that they actually have a form of income they should be paying tax on. And I think if they did know that, they would be fuming. And then, I just think that would be interesting. So I'm interested to see, do the IRD do anything to educate people of that?
And I think that ties in with an overall theme that we're pretty hot on in our pods, is involve your accountant with what's going on. And you've got to remember, the accountant is on your side. They don't work for the IRD. You actually pay their bills. So it's in their interests to give you advice that suits your circumstances. And if you're not happy with it, keep asking. And if you're asking and still getting dumb answers, it's probably time to find a new accountant.
Yeah.
But everybody's circumstances are different, and pretty much everything you do in business is going to have some kind of tax impact. And it's surprising, when we come to do a set of accounts and it's, we look at it and there's some low-hanging fruit there that you've got accounts receivable that are sitting there that are months and months and months and months old, and that's a sale that hasn't been collected in cash. And you have the discussion with the client and you go, oh, yeah, they paid that in cash and we've banked that. Or, oh, no, that's gone through the FPOS terminal. We had to send them, they wanted an invoice. We generated them invoice, but that went through our online sales, so it's already banked. But we've essentially recorded the income twice. We need to write that accounts receivable piece off. Or, in fact, geez, there are some debts here that are bad. Let's review that, write them off, get that profit down so that we're not overstating sales or overstating the profit because we're being lazy on the accounts receivable side.
Yeah.
The other side of that would be, it's so easy for business owners to go, oh, gee, I've received some cash from a customer, I'll code that to sales. And the reality is it's a deposit. And it's just like, we're educating our clients or business owners in general, ask for a deposit. And if it's in February and March and you're getting 30 or 50% up front, but you're not doing that work until May, June or July because you're wanting to lock in your workflow and people want some certainty, you go, yep, I know you're a busy person. To lock you in for next year, I'll pay you $5,000 up front. That's income in advance. That's not income until you actually do the work. So why pay tax on it in the 2024 financial year when you can move it legitimately into the year that you're going to do the work and pay tax on it at that time? And then they'll pay the balance of the 50% or 70%, depending on how much of the deposit was that they paid, and then pay the tax when you get all the cash.
Yeah, good, mate. I just written down deposits held. I think people need to understand that better, especially in a world where we are increasingly asking for deposits. Similarly, on that, stock at cost price, we see the odd person who's like, "There's my stock value." I'm like, "Whoa, that's pretty high." Yeah, that's what it'll sell for. We're like, "Oh, holy shit, we need to include it at this cost price or its net realizable value, not what your retail value of the stock is."
And it's really important that if you've got stock and it's a reasonably large holding of stock, so we've got clients that have got stock in the hundreds of thousands of dollars, that every year they give us their stock number and we ask them and say, hey, look, have you reviewed this? Is this stuff valued correctly, or are we sitting on some old or obsolete stock here that just needs to be written off? Because the value of your closing stock is going to impact profit. And if your stock value is overstated, your profit's going to be overstated. So it's important that we're reviewing stock.
Yeah. The other one that I think is now quite massive with interest rates being higher is home office. Now, most of our clients are pretty good, and we'll suggest to them to do their home office for two reasons. Three. One, it's legitimate and you can, and a lot of our clients genuinely work from home. And what we've noticed over the last 7 years of building out Next Advisory from nothing to over $1 million in turnover is that they're using more of their property to work from home because it's more of a done thing. And so then when they actually model it out and realize like, oh shit, it's 20% of my property that I use. And they go through and they work out with the increase in costs of interest and insurances and power and all those things that they're using personally, they're claiming now a 20% deduction of that, say. That's a fifth of those expenses. It's pretty good. And what that does is it decreases their profit. And that means that there's, for most of our clients, a third less of the tax to pay because we're usually trying to encourage clients to be profitable. So for every $10,000 of home office, they've got $3,300 worth of tax that they don't have to pay, sometimes $3,900. But what it also does is it allocates a credit to their shareholder current account. And if you do that over time, because we're journaling it in, that's money that can come out of the business at some stage as well that technically the business owes to them.
Spot on.
And it can help correct an overdrawn current account or prevent it from being overdrawn as well, because they might, throughout the year, maybe buy something that is not tax deductible and we say, sorry, mate, that one's got to go to drawings. Well, now it's been offset by the home office calculation at the end of the year, so it starts to balance back out. So if you're not doing home office, we're always a bit perplexed with clients being like, are you sure you don't want to spend half an hour working that out?
Yeah, and then when you
Could
work
save
out
you thousands.
when you work out and say to them, hey, look, the tax benefit or saving from you spending half an hour of doing this. Yeah, okay, I'll have that back to you.
Yeah, like, no, we've never done that in the past.
Yeah.
Never really thought it was worthwhile. Okay.
It's not so much of a big deal these days with the likes of technology that's in play, but it used to be big back in the olden days. Maybe it's because people have forgotten, but if you pay for expenses personally, and if we're using MYOB or Xero, it isn't going to be in there because it hasn't gone through the business bank account. So if you've paid for something personally, let your accountant know to go, oh, hey, look, we've racked up all of these costs on our personal card. You know, Bev, she wasn't paying attention when she was down at the shop, down getting some parts for the car. And here's our list, boof, get that in there. The other one would be, and again, it's not a really common one, but if you've got a personal car and you're using it for business use, keep a record of the mileage and say, hey, look, you know, we've done these trips in this car. It's not a business car. Apply the mileage rate to these kilometres, please, and put that in the accounts.
Oh, yeah. The blowout in the background.
Bit of a blowout happens from time to time at Next Advisory.
The books got bored of us.
Yeah.
We'll be right.
Sorry, mate.
Yeah.
So motor vehicle expenses by way of mileage charge. That can be some low-hanging fruit. Again, it's not a big one because most people have typically got a vehicle in the business and they're just paying for all the costs through the business anyway. But if there's a personal car there that you have used for business use, record the mileage, let the accountant know and say, make sure that's claimed.
Some people, when they start doing really well in business, they like to have a fancy vehicle because that's their thing, and that's sweet, and that might depreciate at quite a high rate as well. So often you might see a vehicle, and if you were to look up the ownership of that, I think you'd find a lot of the time it may actually be owned by a business, not an individual.
Yeah, right. It's just a blue RS4's coming to mind.
I was thinking about that Lambo behind you, for instance, but I wonder, can you just search a database of who owns a vehicle these days? You can?
There
for
is.
free?
No, not for free.
Okay. Yeah.
There is a website, I believe, carjam.co.nz.
I see.
And I think you can pay. But if provided you've got legitimate reasons to be searching the database, you can get the ownership records.
But definitely if you've got vehicles and you are in business, you want to be speaking to your accountant, having a discussion about when you use them, because it's very expensive to repair a business, to fuel it, to tyres and all those sorts of things these days. If there's a chance that could be tax deductible, we probably want to have that conversation.
Yeah, definitely. I think with minimising tax, it's also important to touch on there's two different types of tax. There's income tax and there's goods and services tax, GST. GST can be an important one, particularly if you're buying something and you're expecting a GST refund. And the classic one would be a motor vehicle. Now, most people are registered on a 2 monthly payments basis. And payments basis, well, 2 monthly, first of all, means you are doing GST over a 2 month cycle. So it'll be April, May, then June, July, August, you get the drift.
Well done.
Thanks, mate. And it's on payments, which means as you pay for stuff. And if you're buying a vehicle and let's say, the dealer's going, geez, it's April, we want to clock our numbers, we'll do you a deal, we'll sell you this Ranger in the beginning of April, you've got to wait until the end of May before filing that GST return to get the refund.
Yeah.
So a smarter thing to do would be buy that car in the last week of May. The dealer may or may not sharpen their pencil because they'll be wanting to hit their numbers at the end of the month. And this is a Ranger they can get an easy sale on. And then you file your GST return for the car that you've just bought a week ago and you get the refund a couple of weeks later.
That's ensuring that you've got the old timer supply correct and stuff like that. Is that right? Where you've taken ownership of it in May? Because haven't we had that before where the idea said, hey, knock, we want all the details of this. Yeah. Oh, righto. Because then you file it in June. You've got to the 28th of June to file that, but you'd be filing it on probably the 1st of June. Yeah. And then they don't actually have to refund you straight away. They've got time where they can say, oh, we want to see the details. Yeah. If you're going through a tax agency, hopefully you might be a bit more likely to have it refunded faster. Yeah. I think a good thing to be mindful of. And also, what basis you're on for GST. Are you invoice basis? So therefore, if you send an invoice, you're triggering GST. A lot of people turnover less than $2 million, so they don't have to be on invoice basis. They'll be on payments basis. When you are paid for your invoices, that's when the GST triggers. You might send an invoice, doesn't mean you have to pay the GST yet, or doesn't mean it triggers. It's triggered once you get paid. Had a client ask me today, shit, our GST bill's high, wondering, do we incur the GST when we get paid or when we send the invoice? You're on payments basis, mate. It's when you receive that money and when you make payments as well. But they've done bigger sales than they ordinarily have over the last couple of months. So they've got a bigger bill.
Taxes triggering.
Yeah. The other one that made is a bit of fun that we don't hear too much about, the old AGM, the annual general meeting.
Oh, yes.
Fully deductible to put on an annual general meeting. So you want to be careful about how you do that, but there might be a little bit of leeway there to throw your AGM at Eden Park and invite all the shareholders along, and like some of the big corps do, and know that those expenses are probably being fully coded to AGM expenses once a year.
Yeah, and the odd business owner that we've been known to come across who've just recently come back from Fiji.
AGM in Fiji, really?
Yeah.
Okay, yeah, they hosted their one over there.
Go up there and bring all the stakeholders and the shareholders along and go through our agenda, and that only takes probably about 3 hours over 3 days.
Yeah.
An hour a day. We don't want to push it too much while we're in Fiji. That heat's really going to get to us. But then there's all the other business planning and strategy bits and pieces, not just the AGM. But provided their business trip, or the purpose of the trip is for business purposes, you can claim it.
Yeah. So two things there, I guess, is international travel, which can often be 100% tax deductible if fully it is for business.
Yep.
Not just like, we'll go
Just
over
happens
there.
to be incidental. We're just like,
The Formula One's on.
Yeah, we're going to Singapore for our AGM, which just so happens to tie in with the Grand Prix that's on. And we'll have our AGM, and then we go, right, here's our agenda. Right, Luke, okay, yep, let's talk about this, talk about that. Right, that's our AGM done, let's carry on.
Yeah.
Yeah, that's probably not terribly legit.
I think with all of these things, there's actually really good resources on the IRD website these days, because I think they know so many more people are DIYing their tax returns and trying to find this information. And we live in a world where we don't just rely on the accountant. We're like, no, we'll go and find the answer. So the IRD done quite a good job at providing examples and providing easy to find information. So you might decide, okay, I'm going to look into running my AGM and to ensure that it's fully tax deductible, and go and read up on the information that the IRD have on that, and think to yourself, could I answer the question should the IRD ask me, with all the things that they list out?
Yep. Same
Thing with international travel. It might say that it has to be for business purposes, and it's not just like we're going and it's incidental. So then you have an itinerary, for example, and okay, here's what we did over those 3 days. And your AGM, even if it is in Fiji, you might say, well, we had shareholders back home, we invited them via Zoom, and they could participate in the AGM.
The other one, mate, and when we were talking about it before with GST and cash and payment spaces, just reminded me, the amount of people that are on Xero and they use full Xero, they send the invoices out, but they don't process the supplier invoices in Xero.
Yeah.
They just go, I've got a payment due, I'll just pay it and then cash code it, is what we call it in the techo lingo, but you just process that straight to the expense account when you're doing your bank rec. What we're missing out on there is recording the expense in the month that it actually happens. So if you're paying for something in April, chances are it relates to an invoice that you incurred or received for something in March.
Yeah.
And that's really important at year end, because that's accounts payable, which your accountant's going to want to know about. So you've got to come up with a list of basically every bill that you're sitting on that's unpaid. And the easy way to do that is go through your bank statement and go, what did I pay in April, May, June, if you're a really shit payer, and go, oh, yep, these are bills that relate to March and earlier periods. Give them to Bob, your accountant, and say, hey, mate, these are all the costs that I incurred. I went and got the blimmin' new tyres on the Ranger, got those in March, but I didn't pay for it until April. That's an accounts payable. That's a motor vehicle expense. It's going to bring your profit down.
Yeah, we had a client who did this at year end, and basically they do exactly that. They send invoices through Xero, but they don't add in their bills. And in April, they paid $40,000 worth of expenses that were from March that they pay in April. And that's just how they do things. They pay it around the 20th, between the 15th and the 20th. So they waited till after that. They listed them out and they said, hey, can you please include this when you're doing our prov tax calculations? So there's $40,000 worth of expenses that if they didn't tell me, I wouldn't have known about. Similarly, with another client where we did their prov tax calculation, I said, hey, pay X, Y, Z. And then we did the accounts and I spotted on the 2nd of April, for instance, and the 4th, these large lumpy amounts that went out. And I said, hey, are these for March? Just confirming, are they? Yes, they're March bills, and they sent our invoice in and we pay them. Okay, what about this one in May? Oh no, the May one is definitely April. Great, we include the ones paid in April back into March, brought their profit down. By the time we did their home office as well, they'd well paid enough in provisional tax, get the refund, and they're in the top tax bracket. So the contractors that they used, the 20 grand that were paid at the start of April, $8,000 worth of tax they didn't have to pay because we knew that it was actually an expense for the 2024 financial year.
Yeah, I was just going to come back to that 40 grand example just to wrap some context around that as going, man, it's punishing admin for a business owner, but would you rather punishing admin, the free time of not having to do the punishing admin, or spend half an hour to do some punishing admin to save you 12 grand, 15 grand?
Yeah.
Like when you start and put that in those numbers, like 40 grand worth of creditors,
big.
Like excluding GST, there's 12 grand of tax-ish
Yeah,
that you're going to save.
Plus, then you're going to have to pay that in your prov tax in 3 installments.
Exactly, because your profit's going to be overstated. So come P1, it's going to be overstated by the amount of the increased profit.
Yep.
And so it's just like, why? Take the time to take half an hour to save yourself the 12 grand.
I think it's just on that too, geeky accounting. So when we include those bills, we include them at 31 March 2024. On the 1st of April 2024, they reverse. So basically then we put a negative into your accounts, but then the negative is offset by the payment in April, which then means that basically there was no expense in April because it was actually done in March. So that is a bit of that. Mate, this one's probably more of a mindset, but I like talking about this one to get people thinking a bit bigger and differently. Advertising, great way to minimize your tax.
Ooh.
You might be getting close to the end of the financial year, know that you're doing well, and know that actually, you know what, if you go out there and if you keep adding people into your pot, you're going to make that money back in time. Well, we are allowed to claim 100% tax deduction on our advertising. So why would you not look for ways that are tax deductible to go out there, grow your brand, and also that could then lead to more goodwill over time if you're then going to sell the business as well. So you're going to make that money back, not in the lifetime value of customers that you find, so not just in that, but also maybe the goodwill of the business through building it up when you go to sell that too. But you can claim a deduction on that. So you have to have a good strategy. You have to know what you're doing, but it can be common for businesses who think bigger and do have a marketing budget to think, right, let's chew some of this up or some of our profit up leading up to the end of the financial year, knowing that you're going to make it back in April, May, etc. And so for us, as an example, mate, I thought, what could be quite smart for us, if we, say, wanted to do something like this, we could host a massive loss-leading business advisory educational seminar in March.
Ooh.
That costs us a lot of money. We put it on.
Yes.
We don't make much money.
No.
But in April, we pick up a new client.
Ooh.
Then in May. And so we bring our profit down and then we make it all back in the following year. And then it just keeps getting bigger.
We're getting the collect later on.
Yeah.
So much, unlike the TAB,
yeah,
we're getting a return.
Exactly.
Nice.
So, that's something we could do. We don't do that, but it's an example of thinking, okay, what could be done that's legal, but you're going to have to know, can you actually get that back? But obviously all you're doing is then kicking the can down the road because then you're going to get more clients. That's going to be more profitable. And then you've got to go bigger again. So sometimes these shiny ideas that we come up with, you kind of go, is it actually worth it, or should we just suck it up and pay the tax on that? But I can see with tax being wasteful and inflation and tax rates now being 39% for some people and even 33%, people are like, nah, I would rather spend the dollar to see if I can save the 33 cents, which a lot of the times people actually can't, and they waste the dollar to save 33 cents.
I was just about to come up, that was in my mind. I was thinking, I haven't said this for a long time, but the amount of people that come to us and go, geez, Luke and Phil, how can I save my tax, and it's just like, what can I spend? And it's just, and the easy, quick win to say to a client to put it into perspective is, we'll increase your accounting fees. And just to see the reaction on their face and just their whole attitude change, and they go, well, I don't want to pay you guys anymore. But then it proves the point of going, you're wanting to spend $1 to save 33 cents.
Yeah.
Those numbers don't stack up. Like, invest the money in areas that are going to have an impact on your top line or improve your bottom line.
Yeah.
But if it doesn't, then you're just spending $1 to save 33 cents. It doesn't make sense.
Yeah.
If you want to do that, let's just increase your accounting fees. Happy days. Let's go.
Yeah, maybe that's the way we can articulate it is, don't waste $1 to save 33 cents in tax. Don't spend spend $1 to save 33 cents in tax, but invest $1 to save 33 cents in tax. So that's where advertising is different. If you know that you can get it back, then you are decreasing your tax liability, but you're going to make that cash back. The other thing that I think is quite cool, mate, when you're in business that you have an unfair advantage of is you can go and upskill yourself, you can train yourself, you can learn more, and you can expense that in your business. But when you're going to get a student loan to go and get a degree, for instance, not tax deductible. Now, you might do some coaching, for instance, or you might pay for a specific course that's going to get you better at business, and it's got a general relationship with you increasing your income. Might be a $10,000 course that you do, but it's about leadership and growth and sales and things like that. There's a high chance you can deduct that. It's going to decrease your profit in the short run, but you're going to make it back over the long run. So when you are an employee, for instance, you can't really do that. You've got to pay for that with after-tax income.
Cash, yeah.
Or that's why we then go, my employer should pay for this. Yeah,
what more can I get out of my employer?
So it's coming out of their pocket.
Yes, the inevitable that is tax. It's always going to be there. Have you got any other ways to minimise it, mate?
Low value assets, that's it. But you can't even buy an asset for less than $1,000 these days.
Nah, and look, you were kind of hoping that they were going to tweak that threshold, but that wasn't to be. Australia, $20,000 that you can just write off.
Every time I've thought there might be something in the budget,
you've been let down.
Yeah, that's quite practical. I'm like, surely.
Yeah,
no. But I can't believe our low value asset threshold is only 1,000. I reckon the reason they didn't increase it is because they would have had to quantify it. They can quite easily do that because they can collect all that data from the IRD, how many transactions went through minor assets, therefore how many of those may have gone, wouldn't have going forward, therefore the average tax take on that, say it's 30%, or that's going to cost the country $400 million over 4 years, and everyone's like, fucking business owners are getting $400, they're better off. National already copying it from looking after landlords, all of that sort of stuff. They're probably just like, let's park that. That's going to be another soundbite too many that they can push back on. So maybe in the future.
Yeah, spot on, mate. Good pick on the last one there, the low value assets. Make sure you tell your accountant about that kind of stuff, because if they see it, they might think, that is an asset, we'll depreciate that. But no. Let's get the tax deductions rolling through.
Well, there you go. Some illegal ways to decrease your tax. You definitely won't be doing those, but some legal ones as well.
Throwing in there for good mix.
Yeah, be smart, speak to your accountant, and don't do anything that's going to land you in the slammer.